Welcome everybody, this is the July update from Rosecut. I'm joined by Mike. Good to speak to you again, Mike. How are you?
Hi Daniel, yeah, good to speak. It's been a reasonably decent month in terms of stability in the marketplace. Not sure that's going to persist. I think we both agree we have seen what people call a bear market rally, so a kind of a counter trend rally in the context of overall and broad weakness. And I think for as long as inflation remains high and multiple risks, be it Italian politics, Ukraine, etc., supply chains breaking down, climate change, it's getting depressing. I think markets will likely be under pressure.
Yeah, and you mentioned a word at the start there, stability. We've mentioned before some of the political instability in a few emerging market countries such as Sri Lanka, but we're starting to see a few signs of political instability in Europe itself. Not only do we have the changes in the UK, of course, with the new Prime Minister being elected, but there's a few things going on in Italy, for example. We were talking about this just before we started recording. How would you sum up what's going on right now?
Yeah, so I think very broadly what's happening is that from a market point of view, markets are beginning to test at the edges of, first of all, emerging markets and now Europe. And they've been given the excuse by some of the political parties in Italy, Five Star, and who are the populist kind of left to centre party, and then some of the parties on the right, who were in this coalition government with Mario Draghi, and who decided effectively to pull the rug from that coalition. I think for two reasons. One is that as populists having entered government, they've seen their standing in the polls fall. And then the second one is that the far right party, Fratelli d'Italia, the Brotherhood of Italy, they've been on the rise, and they are probably comparable to Marine Le Pen and her party in France, or Viktor Orban in Hungary. And their manifesto it's very anti-immigration, it's actually more anti-globalist than anti-Europe. And they are fomenting tension in Italy. So it now looks like we're going to have an election at the end of September. I think a great disappointment that Mario Draghi has been effectively ejected, given all his accomplishments. So that means we will have volatility in European bond markets between now and at least the end of September. In that background, the ECB has just raised interest rates by 50 basis points to 0%, which is somewhat odd given that inflation across Europe is averaging about 8%. And the ECB is in a difficult place because Europe is having a mixture of these inflationary pressures and recessionary pressures as well because of what's happening in Ukraine. So very complex outlook in Europe, which I think will actually complicate matters more broadly across markets, and certainly for currency markets, for example, the euro has been really volatile recently.
Yeah, and it is incredible just to think of how Europe has this inflation problem and we've only just got to 0% interest rates.
Yeah.
It's remarkable.
If you think back to the days of the old Bundesbank, at this stage they would have aggressively been raising rates, but that's not the case now.
Yeah. Now, one area which has been raising rates is the US, of course, and the concern is that if you raise them a bit too quickly and too high a level, you start to impact on economic activity, which might in some cases actually be something the Fed wants, because it wants to get rid of the inflation problem, and that means demand destruction is actually a useful thing in a way. And we're seeing a few signs of economic downturn emerging. So we have the Atlanta Fed model, the GDP now model, which tries to measure economic activity close to real time. And that's been flashing warning signs for a couple of quarters now. And we had another manufacturing index from the Philadelphia Federal Reserve come out yesterday, which is quite negative. And all of that means that actually bonds have started to perform a bit better, which is useful in the portfolio context, as they usually act as a diversifier when equities are not doing well. And it's one of the things that we've been missing this year, that sort of buffer.
For context, our positioning is quite conservative, I guess, which has been the right way to go. And I think what's happening in the markets is that the debate has shifted from inflation, even though inflation is still very much present towards recession, that's been effectively been good for government bonds, less good obviously for equities, I think.
Yeah, that's right. I mean, we're still in a longer term downtrend, which we've been in all this year. But as you mentioned earlier, we have a bit of a bear market rally at present, which is where you have this counter trend move and markets go up a bit. And it's been helped by volumes over summer tend to be lower than usual, so you don't need as much money to move the market up. And B, the earnings season has been a bit mixed. So companies reporting their second quarter earnings. There's been a few misses, but it's not been as bad as I think people were expecting. And we can see from the performance of what I refer to as some of the lower quality stocks, the more speculative ones. And I was just looking at Coinbase before I came on. They're up 40% in 1 month, which is quite a move. But when it's not confirmed by higher quality stocks moving up by anywhere as close, I think that does lead me to the conclusion that this is still a bear market rally rather than something more sustained.
Yeah, and one of the characteristics of the so-called bear market rally is that what people call the junk, or as you say, the lower quality stocks, they're the ones to rise the most, largely because they've already fallen very, very heavily, and some of them are shorted. They're sold quite aggressively, so there's an element of just kind of buying back some of those or closing the shorts. That's more of a technical phenomenon, I think, than any kind of serious institutional buying or long-term buying. And I think we have yet to see the real bottom in markets for the time being.
Agreed. And so let me finish by just summing up where we stand with portfolios at present, including the latest changes. We hold a bit more cash than we were doing a couple of weeks ago. That's to add to the defensive nature of the portfolios and try and dampen down the fluctuations that we're seeing. That's partly because the energy sector ETF and carbon credits, all the stuff that worked really well in the first half of the year, they're just displaying a bit more volatility as concerns over recession come in, and instead of just concerns over inflation. The other thing we've done recently is we've reduced emerging market equities. This is along with a reduction of all in equities, frankly. And emerging markets tend to be the higher risk areas in equities. And they're also quite vulnerable to some of the things we've been going on in the world. So a stronger dollar, for example, is not generally good for emerging markets. Global GDP slowdown, not good again. And then we also have this, it sounds slightly paranoid to talk about geopolitical risk all the time, but we did have this remarkable press conference a couple of weeks ago, which is worth mentioning just for the record. And it was with the head of military intelligence for the UK and head of the FBI, so that's a US agency. And they were quite firm in their criticism of China and really highlighted the business risks involved if something significant did happen there. And it's just one of those things, it's like a signal. You just keep an eye on that sort of situation and remain mindful of the risks.
As a final point, how I would interpret it is that it's a sign of a more divided world between East and West. Obviously, the war in Ukraine has done a lot to further divide the world. That reads across to trade and investment, and there will be certain sectors now in Europe and the States that will be very wary with trading with China. So that's going to mark currency flows, it'll mark investment flows, and it'll mark the fortunes of different kinds of companies, and even companies that have got exposure to Asia, for example.
Yeah, I mean, all of my career, we've always invested globally within portfolios, almost without a thought for these sort of things. And I suspect that is going to change over the next few years.
Exactly. Yeah.
And on that note, we shall finish up.
Yes, optimistic note to finish on.
Yeah. I mean, just as a reminder, the portfolios remain defensively positioned. We've not been subject to excessive volatility within portfolio performance, so we await a more attractive opportunity to add risk back to equities. Mike, thank you for your time as ever.
Thanks, Dan.
Look forward to chatting next month.